Good afternoon, everybody. Today is Wednesday, the 27th of July, 2011. Let's take a look at this market here. I'm Brian Shannon, and haven't been on in a couple of weeks, so we went on a nice, relaxing vacation and avoided a lot of market volatility. Last week, obviously, I missed what turned out to be a good little rally here, but we are now correcting that and coming back down to important levels here. The S&P 500 lost just over 2% today, undercut that 10 and 20-day moving average right on the open, and closed below the 50-day moving average as well. So, it seems like the market is finally dealing with this elephant in the room, which is the political nonsense in Washington that everyone's talking about, and no one knows what's going to happen as far as any reaction to whether they create a deal or whether it just continues to be a big mess here. But I think that people are seemingly generally disgusted with politics, and that disgust might be turning to the market here a little bit right now. So we've been talking about the potential setup of an inverted head and shoulders pattern on the S&P 500. And this clearly, we had a nice left shoulder. We had the perfect looking little head here and then the right shoulder. And what this pattern is supposed to do, and what it was looking like it perhaps had the chance to do, was then break above that neckline. Breaking above the neckline is what would have made this into a bullish continuation pattern. However, what we had happen instead today, of course, was that the S&P 500 gap down. And let's just frame that on a 2-day chart. We had the gap down right down to daily S2, which a lot of times is a level where buyers come into the market, but obviously today that didn't provide really any support whatsoever. If you look at the 1-minute chart here, from the 9:30 S&P, the equities opening, we were briefly above the volume weighted average price here today, but the market failed in there. And then as the market got weak again, and it was it broke this support here late in the day, and just continued to basically close right on its lows here. And I see it's at 130 and 34 cents right now. So the market is, had a big drop today. Obviously, that inverted head and shoulders pattern is what I would consider to be failed right now. If we're going to see, a break past 136, we'll deal with that as it comes. But now that we're 6 points away from it, 5.5 points away from it, it's an unrealistic, not expectation, but it's an unrealistic scenario for the market right now. What we have instead are some pretty important levels here. We broke this. We broke the 50-day moving average. Obviously, we broke this little uptrend line that's kind of started since that push past the 130 level, where we had that real strong rally up to the neckline. Our pullback to the 20-day moving average, 20 and 50-day moving average. We basically just undercut that low here in the S&P 500, and I don't know if I have that right. Let me I don't know why I said that, because that's not true. This is where we where we are now. So this is the low from that right shoulder here. We're looking at a 10-minute chart right now. And yesterday I was talking about the pattern of lower highs and lower lows, and that if we gave up this 133 level, that's where the market would likely continue down towards at least maybe 132. And trying to determine where exactly it's going to go isn't necessarily the job. But if you get the trade on in the right direction, which it would have been obviously short today, and maybe you would have entered it multiple times depending upon your own style. The point is that the market has given us warning signs. Joe Fahmy did a great job of pointing that out yesterday through a number of tweets and a blog post. What I was talking about yesterday that I thought was of concern was really the Russell 2000, because we had seen the Nasdaq. The Nasdaq broke out a couple days ago past the year highs, and what we had seen there was actually a 10-year low in the Nasdaq. 10-year high in the Nasdaq 100. These levels haven't been seen since early 2001. So, it looked like everything was going good, basically. And, a lot of times, I used to like to bring this quote up forget the name of the song by the Grateful Dead, but when life looks like Easy Street, there's danger at your door. And that's why the number one job for traders is always risk management. Manage your risk, know where the market has come from. It just rallied basically from 57 to 65%. Is that the time to be buying because of a breakout? If you do buy and then you get yourself into a situation where the market gaps down, well, you have to peel that band-aid quick, or figure out what your risk management style is. There's no one saying that you're not going to get stung by a gap like this sometimes, but the reasons for concern were really, my biggest reason for concern was the Russell 2000, and that it's been trying to create this similar type of inverted head and shoulders pattern in here, or you could look at even like a 30-minute, or let's go to 65-minute time frame just to get some more days in there. And you can see here's that left shoulder, here's that head, and we had a brief movement above it, but this general area was our resistance, 85.5 to 86, and then we had this what was looking like a nice higher low on that 65-minute time frame. And if the Russell could have gotten back above about $84.35 today, well, we might have had a much different outcome. Or this was yesterday, actually. 3 days ago. But obviously, we've had now 3 days of downward pressure in the Russell 2000, and it was even looking like within this right shoulder that maybe we were going to create an inverted head and shoulders pattern here. Those are potential scenarios. If you're trading just based on patterns and looking at a technical analysis book and saying, well, that's an inverted head and shoulders pattern, therefore it's bullish, therefore I have to have a bullish bias, that's not what you should do. You should look at it and say, here's the potential for a bullish scenario based on this pattern that a lot of times leads to, a break past resistance leads to further upside. So therefore, if the market does that, I'll position myself accordingly. However, if the market does not do that, then I'm either going to stand on the sidelines and cash and avoid this type of sell-off, or you're going to put your analysis down to shorter term time frames and say, wait a minute, we've got a market below here the last what time frame am I looking at here? A 10-minute time frame. The last week, we've had a little bit of resistance in this 84.5 level, and then we had a gap down with a lower high, another lower high, a lower low, and another lower low. So this pattern was below, lower highs and lower lows below the declining 5-day moving average yesterday, and I wasn't short. I didn't see something like today's decline occurring here with close to 2.98% loss in the Russell 2000. But when you look at this Russell 2000 movement and the levels that it's taken us down through, it shows that this is some real selling in here. The volume was increased in the Russell 2000, in the Spider, and in the Qs we had heavy volume as well. So these markets, looking back to the Qs now, you can see we've got this trend line that it's trying to hold above, and we've got this 57 level that will be important to look at because this was the lows basically from last week. The 57 level, when we look at the daily time frame, is also where we have this 50-day moving average. So these markets are really showing a lot of volatility, and that volatility is being brought about by uncertainty from earnings reports, uncertainty from economic news, international downgrades, and all that sort of thing. And the market does climb a wall of worry, and it doesn't seem rational at the time that it's doing that, which is why we have to trust price action and say, well, the market, just because I have a bearish view, do I want to keep shorting into it? And some people do that, and on a day like today, you get back to break even from your average cost. Whereas you look at it and say, hey, it was such a big down day, I might have had all this short exposure. How come I'm just breaking even? Because the advantage wasn't really in your favor at that point yet. But looking again at the Nasdaq here and this failed breakout to a 10-year high that led to this fast move lower, we have to ask ourselves, is this similar to the Nasdaq, or I'm sorry, the Russell 2000 in April late April of this year, when the Russell 2000 broke out to all-time highs. So don't forget, I mean, this is a good example, the Russell 2000 that is, that we broke out to all-time highs in April of this year. Subsequent action in there is we've been trading sideways at best to a market where we're looking lower, and we haven't been able to surpass that level right now. And now we have to ask ourselves, is this NASDAQ breakout and failure now going to lead to a similar type of downward pressure in the NASDAQ 100? So we can take a look at the longer term trend line, which had stayed intact with the sell-off, from the May-June lows, and looking at the weekly chart, it's still, it's not bearish. You look at it, you can't really call this bearish. And can you call it bullish? We're basically still in this bigger range, but we came up through the top end of that range and failed. So it seems as though we should have further downside. Now, that doesn't necessarily mean tomorrow. We had a big down day today, and maybe we'll get a little bit of a bounce up, but now we're going to be below these declining 5-day moving averages in all these markets, and that's reason to think that it's now, from a swing trader's perspective, it's guilty till proven innocent. Let this thing shake out before you decide that you're going to get long. We're still, we've got earnings. We're in the middle of earnings season, and there's been some good responses to earnings, obviously, and there's been some disasters as well. We've seen a lot of stock charts and individual names getting destroyed recently. Stocks that were looking good for a breakout here maybe a couple days ago, like GSM, looked like, hey, if it could break out here, this stock could get going to the upside. Obviously, it didn't do that. If you look at Men's Warehouse, it looked like, hey, maybe it could get going above this level and continue higher. National Oil Well Varco breaks out to a high and runs up and pulls back strong intraday, now looking like a failed breakout. Panera Bread today had earnings, and this was a very bullish looking chart. It looked like a nice consolidation, this prior resistance holding in a tight range right before earnings, and this is why I personally don't trade earnings reports. I don't think there's an advantage to positioning yourself long, really, or short here. It could go either way. Now, these are some examples, obviously, of where it's gone wrong. There's been some good ones as well. But the point is, the market still, back to the NASDAQ, you look at the NASDAQ and say, well, typically, historically, the semiconductors lead the trend of the NASDAQ. But what we've seen in here is, just yesterday, we saw this market rally back up to the declining 50-day moving average. We've got lower highs and lower lows in here. This level that we were talking about for several weeks, this 32.10 basically, has been the, we were talking about, if you go back 2 weeks ago, that it seemed like, you don't want to get short. You don't want to get short on the break of this obvious support, not after a decline of the magnitude that it had seen coming into that. So in other words, the semiconductors dropped 8-10% down to this what had been viewed as a support level. Now, why on earth would you put your stop below here? It doesn't make sense to me. Or why would you sell short below there? It's similar to the buying this 10-year high breakout after a move that went from 53 to 70. It's similar to buying the Russell as it breaks out after a move that went from 81 to 87. So after these 10% moves, buying a breakout isn't usually going to be an advantageous trade. Selling short after a 8-10% decline because of an obvious level of support break isn't going to give you an advantage. So you have to use multiple time frames, obviously, as I always talk about. But you look at this these semiconductors, it's it's clearly, having trouble here in this 32 level. If we're to break down through it and hold below it for 30 minutes or so, and then there would be an advantage, I think, the next time to sell short, because we've already, we've sucked people in on the short side. The weak longs got out, and then they regretted getting out after this move higher. The shorts, covered. Now they're reestablishing their positions and saying, "Shoot, I knew it," or they're just standing there shell shocked, which some people do, and say, "I knew this market was going lower. How come I keep getting stopped out of it?" And that's the nature of a volatile market. That's a market that, when you look at the weekly chart and you look at the S&P 500, it's possibly undergoing distribution. Now, we've seen this situation before where it looks like distribution and then it breaks down, but then the market recovers. Breaking back down below these lows for the year, I think that next move lower, it would likely lead us to a bigger drop, and maybe a test. Well, we've got basically the test of the trend line coming up before that. So anyways, the market is becoming, on weekly time frames, more neutral. On the daily time frames, we're showing volatility. Well, stage 1 and stage 3, stage 1 accumulation and stage 3 distribution, represent indecision. And when there's indecision in the markets, it means conditions are tougher. The bulls don't have advantage. The bears don't have an advantage, except for the shorter term time frame. So you have to look at that and say, either I'm going to avoid the market completely, or I'm going to take a couple of very smaller trades and look at it and say, risk management, staying alive and healthy, is more important than trying to capture every one of these 3 to 5% turns, because I don't know anyone who's doing it consistently. The only people I know who are capturing the bulks of these moves consistently are the liars, and you just unfollow them on Twitter. You ignore them. There's no reason to think that anyone's going to be perfect in this type of environment. It's a game of defense first and foremost, and understanding that and protecting your capital is what's going to basically keep you in the game for when it does become easier. My friend Russ Masiri, who is a great follow on Twitter, is a successful trader. I know he's a successful trader investor, and he's really into fishing. And like fishing, it's about being somewhat. I said patient to him. He says, "No, Brian, I'm not patient," but he understands where his results come, and being patient with winners. If you're driving your boat around, testing the water here or there, there's no fish, let's move on. There's no fish here, let's move on. And then you get into a big school of fish, or if you're in the market and these stocks start working for you, you don't want to panic and sell them, and you don't want to say, "Hey, well, fishing was good in this spot. Let's go back to that dead spot we were at earlier and see if the fish are there too." That's stupid, just because it might have a prettier view. You're there to catch fish. Our job in the market is to make money. So if you're in a money making environment, you go with that, and you let the profits come. And when the market starts telling you it's not is easy, listen to the market, listen to the water. The water's saying, "Hey, the fish aren't here. Where are the fish? Let's go find the fish." Until then, there's no point in dropping our lines out. There's nothing on the sonar. There's nothing showing up. The setups are busted. There's a lot of bad damage done to certain parts of the market. So now's the time to go fishing, literally. Anyways. So that's enough of that. Let me just talk quickly about the stocks that I told subscribers we wanted to keep an eye on today. And basically what we're looking at was Clean Energy, CLNE. On the long side, this stock has been a volatile name. It's got a big short position in it, but it's been up on big volume. Yesterday we traded it successfully as it broke some resistance, but today it failed. It came back in and completely failed. Anyone who was in it from yesterday, in my opinion, should have been out of this thing today. So the breakout failed. Now, as far as Clean Energy goes, we'll have to monitor it and let it reset up. We're looking at EMKR as a potential break past $3.13. but it didn't break past 313. We want to buy above. Was it 313? What was the level? Where am I getting that number? 310, $3, I guess. I was thinking about some. Oh, I know what it was. It was another small stock, SSN, 2 days ago. But we were looking at buying this above $3. Well, it didn't get above $3. We were looking at saying, hey, it's starting to consolidate. This prior resistance seems to be holding a support. It's holding this 5-day moving average. Now, if it can break out and make a higher high, we want to buy it. We don't want to buy it in anticipation, especially in a weak environment, because that's where you get your hand slapped. I was going to say something else. Pay was one we were looking at on the downside because it's been it's below a declining 10, 20, and 50-day moving average. It's below its 200-day moving average, and the stock's been under pressure. In today, what did we have happen? We had some strength early on, right up to that declining 5-day moving average. On a 2-minute chart, you can see had you come in short, there was a lot of pain right on the open. But if you got in as it breaks below VWAP and some support, there was opportunity there. Acme Packet was another one that was looking vulnerable. And APKT, same thing. It gapped down here. So was there an advantage to getting involved in this one early? Early on, I don't think there was. I didn't get involved in this one. It's one of those things where you can look at it and say, hey, it looks vulnerable. But if the market doesn't give you a low risk entry in the morning, in my mind, you can't just chase it. So what I mean by that is, I don't like to sell short a gap. What I prefer to do is see a gap down, come back up a little bit, and then short it at this point with a stop above that high. The market's not always going to give you that opportunity there. The market clearly didn't give you that opportunity in this name. So does that mean I should have broken my discipline and just sold short on the open? I don't think so, because most of the time I break my discipline. I have a discipline because I've broken the rules enough that I know the advantage isn't there, and I'd rather miss the opportunity than beat myself up for saying I'm getting what I deserved. Only an idiot sells short this weakness, and that's my mind. Maybe that works for you. You have a different set of rules. That's that's about coming up with your own method in dealing with the market, basically. Las Vegas Sands we were looking at yesterday. I didn't know they reported earnings. I wasn't paying attention to that, so I didn't think there was opportunity there. Viropharm, VPHM, we were looking at this one as a potential move above this resistance. And VPHN still has a nice looking daily chart. We were talking about it yesterday because it keeps coming up to this $19.85, $19.90 level and backing off. Well, yesterday it started to back off, and I was saying this is what we look for. We don't want to buy after this type of move. What we wanted to see was maybe a little bit of weakness this morning and then something that looked like this. And this would have been the place right here, basically, to purchase this stock had it done what we wanted it to, basically, which was a little bit further pullback and then push higher. Our stop would have been below whatever this pullback low that I was imagining would have been. That's the setup. That was the scenario. That was the anticipation. So because it didn't do that, and instead it got weak, and it's basically stayed below its volume weighted average price and its 2-day volume weighted average price, so since yesterday's move, this wasn't a stock that you wanted to get involved in. Instead, you want to look at it and say the real move would have begun above this 1985, 1990 level. We don't have the right market conditions, so if the market's not giving it to us, let's not force the trade. Same with WPRT, Westport Innovations. These guys are the natural gas vehicle fleet people. I don't know the proper way to describe it quickly, but there's big short position in here. The stock's been strong. You can see this 26 level has been resistance. That was tested. It came up to this, and found support there. It came up and found some resistance near 28. We've been watching this one, looking for the correct entry, and yesterday there was a good opportunity in there after the open, but it failed late in the day. And I said yesterday, it closed below the volume weighted average price. If it can get back above the highs from yesterday, then it's something to look at. But now, it was in a void today. There was no advantage to being in there. The other one we were looking at on the long side was Yoku. Now, Yoku does have a declining 50-day moving average, but, these Chinese stocks can get going so crazy sometimes that it was worth keeping an eye on because it had pretty tight consolidation yesterday. Now, if we look at the volume weighted average price since the event, that is the 2 days it moved up and is held on to those gains, we're still holding it. So I think that Yoku might be a good trade to the upside tomorrow. You can see how it held this 2 day volume weighted average price since 10:30 this morning. Well, on the 1 day chart, at the same time, it also held resistance at the 1 day volume weighted average price. So it was basically coiling. Imagine that 2 day volume weighted average price. It was coiling between the 1 and the 2 day volume weighted average price. So tomorrow, maybe getting above 36.50, 36.55, the Yoku could continue the upside. But we're in a very difficult environment for long side trades. And I would say the same is true for short side trades, that we're in a difficult environment. We've got a lot of uncertainty, which leads to volatility. And then on the bigger time frames, again, that leads to what we're seeing as potential stage 3 distribution or uncertainty, and uncertain markets are very difficult to trade. That's the environment that we're in. I hope you're doing okay with it and not trying to force your opinions and losing money. I'm going to end it here. Thank you for tuning in, and talk to you Friday. Thanks.